40% of Brits don't understand how income tax works. What? I heard this stat on a podcast and thought that can't be right, but it turns out it might actually be closer to 50%. So let's sort this out. We'll break down what you actually pay, when you pay it, and why most people panic for no reason when they hit a new tax band. We'll unravel the emergency tax mystery and why thousands of pensioners are getting surprise checks back from HMRC. Hi, I'm Alefa, I'm a chartered financial planner, and today we're clearing up one of the UK's most common financial misunderstandings: how income tax actually works. If you've ever worried about hitting a new tax band or felt confused by your payslip or pension withdrawal, you're in exactly the right place. Before we get into the bands and brackets, let's make one thing clear. When it comes to your income, most of us aren't just paying one tax, we're paying two. There's income tax and there's national insurance. And both come off your payslip before you've even seen the money in your bank account. Now, while national insurance was originally introduced in 1911 as a way to specifically fund benefits like state pension, sick pay and unemployment support, today it's largely a tax in all but name. The money isn't held in a separate pot with your name on it. It goes into the same big government bucket as everything else. So let's look at how income tax works in the UK right now. The first £12,570 of your income is tax-free. That's your personal allowance. From £12,570 to £50,270, you are taxed at 20%, the basic rate. So that basic rate tax band is £37,700. Now from £50,270 to £125,140, it's 40%. The higher rate tax band is £74,870. Anything above this is taxed at 45%, the additional rate. And what about national insurance? Well, you pay 8% national insurance on earnings between £12,570 and £50,270, and just 2% on anything above that. So let's meet Sarah. Sarah earns exactly £50,270, so the very upper limit of the basic rate tax band. She has a full personal allowance of £12,570, so she pays no tax or national insurance on that amount. The next £37,700, so from £12,570 to £50,270 that Sarah earns, is within the basic rate tax band, and so Sarah pays 20% tax on this amount. This means she pays £7,540 of income tax. Now Sarah will also pay NI, national insurance, at 8% of those earnings. This means Sarah also pays national insurance of £3,016. So Sarah's total tax paid is £10,556. Now the next bit is where so many people get it wrong. I've heard it from new clients, I've overheard it in pubs, cafes, even on trains. It's one of those financial myths that just won't die. Sarah gets a £5,000 pay rise. She's buzzing. She tells the girls over a glass of wine, and one of them says, "Careful, you'll be in that 40% tax band now, you'll lose nearly half your wages to tax." And this is the mistake. Yes, Sarah has now entered the higher rate tax band, but that doesn't mean her entire income is taxed at 40%. It's only the extra £5,000, her marginal earnings, that get taxed at the higher rate. She pays 40% income tax, which is £2,000, and she pays 2% national insurance, which is £100. So in total, she pays £2,100 in tax and takes home £2,900. So despite what her mate says over a glass of Pinot Grigio, Sarah's not being stitched up. She's still nearly £3,000 better off. Now, not to be outdone, Jane announces to the group that she's just been offered a pay rise too. She's currently earning £100,000 and her boss wants to bump her up to £105,000. So cue a round of applause and congratulations until somebody pipes up, "Ooh, that'll cost you." Now for once, they're not entirely wrong. Here's where things get a bit sneaky. In the UK, once your income goes over £100,000, you start to lose your personal allowance. £1 lost for every £2 you earn over that threshold. So by earning an extra £5,000, Jane doesn't just pay 40% income tax and 2% national insurance, she also loses £2,500 of her tax-free allowance. And to make things worse, this £2,500 doesn't get added to her basic rate tax band at 20%. It becomes part of the higher rate band between £37,700 and £125,140 and is therefore taxed at 40%. Jane loses £1 of allowance for every £2 she earns over £100,000. So let's look at what happens to a single extra pound earned over £100,000. You pay 40% income tax on it because you are a higher rate taxpayer. That's 40p tax on that £1. But because your income has gone up by £1, you've just lost 50p of your personal allowance. Remember, £1 lost for every £2 earned. That lost 50p is no longer tax-free, it's now taxable, and it's also taxed at 40%. So you pay another 40% of 50p, which is 20p extra tax. So the real cost of an extra £1, 40p of normal tax, 20p from the lost tax allowance, at 60p on £1 of extra income. Including the 2% national insurance, that equals a 62% marginal rate of tax. So Jane pays 40% tax on the full £5,000, which is £2,000. But because she loses £2,500 of her personal allowance, that chunk is now also taxed at 40%, costing her another £1,000. So her total income tax on a £5,000 pay rise, £3,000. Then there's national insurance at 2%, which adds another £100. So Jane's total tax bill on a £5,000 pay rise is £3,100, meaning she only keeps £1,900. She keeps less than £2,000 of her £5,000 pay rise. That's why we call it the 60% tax trap, because your effective marginal rate is 60% or even a bit more when you include an I, and it applies to income between £100,000 and £125,140. That's the danger zone. It's not a mistake, it's how the system's designed. But most people have no idea it's happening. Now here's where the system gets a bit stupid, frankly. Imagine Jane's income has gone up to £125,140, which means her personal allowance is now completely gone. She's officially clear of the 60% tax trap. So what's her marginal rate now? It drops to 45% income tax and 2% national insurance. That's right, it drops. Once she gets past £125,140, she's actually in a much simpler position. No hidden penalty, just a flat additional rate of tax on any income above that threshold. Let's say Jane gets a further pay rise from £125,140 to £130,140. That extra £5,000 is taxed at an additional rate of 45%. She'll pay £2,250 in income tax, £100 national insurance, and keep £2,650. Compare that to the same £5,000 pay rise she got earlier, which cost her £3,100 in tax during the taper zone. So her marginal rate has fallen by 15%, even though she's earning more. And it's not just high earners who get caught out by the tax system. Let's meet David, because his story is about something completely different. Emergency tax. David recently retired and wants to help his daughter with a house deposit. He's already taken all of his tax-free lump sum from his pension and used it to clear his mortgage. David receives a state pension and personal pension totalling £20,000 per year. He takes a £20,000 lump sum from his pension and expects to pay the basic rate of tax, 20%, equaling £4,000. But when the money lands, he's been taxed over £7,000. The problem is, this is David's first taxable pension withdrawal since retiring. And because HMRC don't yet know how much pension income he plans to take for the rest of the year, they apply a temporary tax code called Month 1 Emergency Tax. In effect, they assume David will take £20,000 every month, not just once. That's £240,000 a year, which puts him in the additional tax rate band. So they tax this single £20,000 payment as if it's one of 12. Now the good news is David can fix it, and fairly quickly. Because he hasn't emptied his pension pot, he can go online and complete the P55 form via the HMRC website. That tells them, hey, this was a one-off withdrawal, not my new monthly income. Once submitted, refunds are usually processed within 30 to 45 days, sometimes quicker. I've added a link in the description below, just in case you, like David, have been overtaxed on a pension withdrawal. According to a Freedom of Information request submitted by Royal London, HMRC refunded £10,000 or more to around 2,400 people who were issued with an emergency tax code after accessing their pensions in the 2024 tax year. HMRC have said they will fix this issue by the coming April by moving people onto a cumulative tax code when they first access their pensions. However, this change doesn't mean people won't still be charged the higher rate in the first place. So we've covered a lot today. You know why the 40% tax band doesn't mean 40% on everything. You've met Jane and discovered the bizarre 60% tax trap where you get punished for earning more until you earn even more and then you get taxed less. And you've met David and seen how one-off pension withdrawals can trigger big, unexpected tax bills thanks to HMRC's emergency tax system. If this video has cleared a few things up for you, please do me a favour, give it a like, share it with a friend who's still convinced that the 40% tax band is evil, and maybe even leave a comment below and let me know if you were part of the 50% of Brits who did or didn't understand how income tax worked. Either way, if you've made it this far, now you do. Thanks for watching, see you next time.